Farms.com Market School with expert commodity analyst Moe Agostino is an online educational video series designed to help you, the farmer, improve your knowledge of grain marketing. Farms.com Market School is brought to you by DeKalb Brand Seeds. DeKalb, growing confidence.
Today's video is about fixed forward contracts as part of your grain marketing plan. Today's topics include number one, what are those fixed forward contracts? We'll define that for you. We're going to talk about minimum and maximum price forward contracts. And then finally, we're going to explore basis first and futures first contracts. So today's first topic is about fixed forward contracts. A fixed forward contract is usually well understood by producers. It involves making a sale commitment to a buyer who can be an elevator, an end user, an exporter. The product, corn, wheat, canola, beans, the price will be set, and the future date when that product will be sold can be set on that particular day. Farmers can usually pick up their telephone at any time ahead of harvest and get a buyer's bid for that crop for delivery at harvest time. In fact, many buyers routinely will now make their bids, price, and basis available on their website for products to be delivered at a future point in time. The volume of the commodity the producer is going to deliver to the buyer is also set at the time of the sale. The place of delivery can also be set by both parties to the contract for exchange of ownership. Our second topic today is about minimum and maximum price forward contracts. A minimum price contract is usually set at a lower level than the fixed forward contract. The difference is the cost of the benefit, the opportunity to gain. If the price rises above the minimum, they are available from buyers for most, but not all, crops and locations. A maximum price contract is the opposite of the minimum price contract, and a maximum price is set that the buyer will pay at delivery. Example, a livestock producer buying feed grain. He's concerned that if he doesn't buy the feed grain, that cost will rise on him. That maximum price usually set at the level that is higher than the fixed forward contract. The difference is the cost of the benefit, opportunity to gain, if the price falls below the maximum. Minimum and maximum forward price contracts are just another tool that producers can use to mitigate and manage risk. Our third topic today is about basis first and futures first contracts, but our first part is going to talk about basis first, and then our second part will talk about futures first contracts with examples. So let's go to our basis first only contracts. A variation of the fixed forward contract is to just lock in the basis. This is known as a basis only contract. I'm trying to get producers to understand that you can lock in the basis separately from the futures. If you can do that, you can make more money. So a producer in this case can leave the futures price open to be determined at a later date. This is known as a futures first contract or hedge to arrive. If the futures price, let's give an example, for December corn is $6.50 a bushel and the cash is $6, the basis is 50 under. A producer could call up their local elevator and user and lock in that 50 under December futures. In Ontario, end users, local elevators will pay you up to 60% of that contract up front for doing that basis first contract. No fee, no charge for cash flow reasons, and they will also delay payment until the following year if you want to delay for tax reasons. The producer can then lock in that futures price at a later date. Producers can get access to the local basis bids as many end users and local elevators will display their bids, futures and basis on their websites. To get access to John Jordan's Farm Market News, you can register by using the following internet address that we provided. You can also go to and get access to local, more interactive basis information by visiting the Grain Farmers of Ontario website at www.gfo.com, and I've also provided you a link to follow. In Western Canada, producers can get access to basis from the Canadian Wheat Board and other various local elevators like Bunge and so on and so forth, but that basis is not as transparent as it has been in the US or Ontario. That transparency, however, has improved since the Canadian Wheat Board monopoly was abolished a couple of years ago. In the US, producers can get a yearly fee or pay a yearly fee to get access to GeoGrain basis. GeoGrain provides local basis across many US Midwest states, and I've provided you with the internet web address. If you do not flatten, if you go back to our example with December corn at $6.50, and you locked in that minus 50 under basis, if you don't flatten out that futures price, you will need to roll forward to the next nearby futures month. So the next nearby futures month would would be March. The producer will have up to the first day notice, which is usually around the 28th of the previous month, so 28th of November, in order to flatten out that futures price with that -50. Otherwise, they will need to roll forward into March, and there will be a charge to roll forward. If the spread between December futures and March is 10, and your basis was -50 a bushel under, the new basis off of March futures will be -60 bushels under, but there will be a fee of approximately 5 cents, so the total would amount to about -65 under March futures. We're now going to talk about futures first contracts. Let's give you an example by using November canola at $567 a metric ton. That's equivalent to $12.86 a bushel. And let's assume the cash is at $5.30 or $12.02 a bushel. Therefore, the basis is 37 under or 83 cents per bushel under futures. A producer could decide to wait on the basis. Historically, 37 a metric ton under is wide for a Western Canadian producer that produces a lot of canola in North America. So he could decide to wait on the basis as it's too wide and lock in the futures price at a later date with our local elevator. This is known as a futures first contract, hedge to arrive, and a fee will be applied to execute the contract from 10 to 30 cents a bushel. Please do not pay 30 cents a bushel. You again can go to Chicago and short futures for 5 cents. So if they want to charge you 10, if you're a large volume producer, you can also negotiate that price. Please only pay that 10 cents per bushel. You can again short futures on Chicago for about 5 cents a bushel. The producer will have up to October 28th. Again, we're talking November futures here for canola, up to October 28th, first day notice, to flatten out that contract and lock in the basis. If the producer will need to roll forward to the next futures month, and this would be January, if he decided not to lock in that basis because it remained wide. In summary, knowing about fixed forward, maximum, minimum, basis, futures first contracts should be part of every producer's marketing plan. These contracts can help achieve higher revenue targets and profitability. Producers should focus on using fixed forward contracts as much as possible. Thanks for spending some time with us, and we hope that we have shed some light and insight on fixed forward contracts and how they can become part of your marketing plan and make you a more successful marketer. Until next time, thanks for watching.